see the number, 35 trillion. Guess when we hit it? We should be very, very excited and proud of ourselves.
There was once a time, not that long ago, when the size of the national debt dominated political conversation. In 1992, when Ross Perot ran for president on that issue alone, the debt was about $4 trillion. It has now surpassed $35 trillion.
We did something that so many economists said we would never get to this quick.
They say America is finished, a husk of its former self, because its debt has reached an unprecedented height, surpassing any previous historical mark. The U.S. debt now stands at $35,101,278,179,208.67. $35 trillion, which translates to over $104,497 per American citizen. This year alone, the United States will spend nearly $900 billion on interest payments, exceeding even its military expenditures. While this figure may seem alarming, it's not the real problem. The actual problem is in the relentless growth of the national debt, which is increasing by approximately $1 trillion every 100 days. This growth is accelerating, and the U.S. government lacks a concrete plan to address it. It seems to have abandoned any attempt to tackle the problem, instead anticipating that the situation will only worsen. Even for the world's largest economy, this escalating debt could eventually lead to severe consequences. But how did we arrive at this point? Why does the issue seem to be largely ignored? And where is this path ultimately taking us? But first, let's start by understanding the growing problem of America's national debt. You can think of the national debt like a personal loan you might take for a car or house. Just as people borrow money to invest or cover expenses when their income falls short, governments borrow money to pay for projects or make up for budget shortfalls. When a government spends more than it collects in taxes, it runs a budget deficit. To handle this gap, it borrows money, which adds to the national debt. For the U.S. government, borrowing means issuing treasury bonds. Investors, both in the U.S. and abroad, buy these bonds, expecting to be paid back with interest later. But as the debt grows, it becomes riskier for lenders, making them ask for higher interest rates. This forces the government to spend more of its budget just to pay off the debt, leaving less for important areas like education, infrastructure, and defense. This situation is like a snowball rolling down a hill. The larger the debt grows, the harder it is to pay off, and the faster it keeps growing. Eventually, this can trap the government in a cycle of debt that's nearly impossible to escape. If investors start to doubt a country's ability to repay its debts, it can lead to a debt crisis, causing borrowing costs to soar and leading to economic turmoil. The U.S. has a long history of carrying debt, but the current levels are shocking. The national debt started climbing significantly in the 1980s due to tax cuts, higher military spending, and a struggling economy. However, the most drastic increases have happened recently. The 2008 financial crisis forced the government to spend a lot on bailouts and stimulus packages, while the COVID-19 pandemic led to trillions in emergency funds. Although these steps were crucial to prevent an economic collapse, they also played a big role in increasing the national debt. But there's more to the story, and it's about to get much more complicated. If the debt were only due to spending during crises, it might not be as concerning. The U.S. had similar debt levels in 1946 after the huge expenses of World War II. However, unlike the post-war period, when the U.S. quickly cut spending and reduced the debt, the current situation is different. Even without major global crises or wars, the government still spends way more than it takes in. For every dollar the U.S. government makes from taxes, it spends $1.25. The difference is covered by borrowing. In 2023, the government faced a budget deficit of over $1.7 trillion. As interest rates rise, the cost of paying this debt has become one of the federal government's biggest expenses, even more than what it spends on major programs like Medicare and defense. Now, Imagine a person handling their finances in the same way. It would be obvious they were being financially irresponsible and heading for trouble. Yet, when governments do this, there seems to be little public worry. The unpopularity of tax hikes or spending cuts needed to create a budget surplus and reduce debt keeps politicians from tackling the issue. Instead, they push the problem aside, letting it grow larger and more dangerous. Can the U.S. pay off this massive debt? Technically, yes. But realistically, it's nearly impossible without making harsh changes. While the goal isn't to eliminate all debt, since many countries have some level of it, keeping a manageable debt-to-GDP ratio is very important. However, the current path is concerning. If the U.S. keeps running budget deficits and lets the debt grow without control, the results could be serious. In the short term, higher debt payments might limit government spending on essential services and investments. In the worst-case scenario, a debt crisis could happen, similar to those in other countries. Investors might lose faith in the U.S. government's ability to manage its finances, causing borrowing costs to skyrocket and forcing the government to make severe cuts or even default on its obligations. But still, the U.S. holds a special place in the global economy. The dollar is the world's main reserve currency, which gives the U.S. government more leeway when it comes to borrowing. There is always a steady global demand for dollars and U.S. Treasury bonds, meaning the rules that apply to other countries don't always apply to the U.S. However, this advantage doesn't mean the U.S. is completely shielded from the fallout of excessive debt. Continued unchecked borrowing could eventually shake confidence in the dollar, resulting in higher interest rates, inflation, or even a loss of its reserve currency status. While these aren't immediate threats, they are potential worst-case scenarios. Even though the U.S. has more advantages than any other nation, no country can ignore basic economic rules forever. Spending way beyond its means isn't sustainable for any nation. Eventually, the U.S. government will have to make tough decisions. If it doesn't, the country could end up on a risky path with serious consequences. Take Greece, for instance, during the European debt crisis. Even though Greece was part of the Eurozone, it faced huge economic problems due to overspending and borrowing. The country ended up needing a bailout from other European countries and had to implement strict austerity measures, which included cutting spending and raising taxes. While the U.S. is in a better position than Greece, the dangers of unchecked debt are still very real. The ability to borrow at low interest rates could be at risk. Investors may become hesitant to lend to the U.S., asking for higher returns in return. This could raise borrowing costs for businesses and consumers alike, leading to slower economic growth. Also, a drop in the dollar's value could have serious effects. Imports would become pricier, which could spark inflation. The U.S. would also have to pay more to handle its debts in foreign currencies. These issues could lower the standard of living for Americans. Additionally, a major drop in the dollar's value could lead to changes in the global reserve currency system, allowing the Chinese yuan to become dominant. This shift could have huge effects on the U.S. economy and its power on the international stage. In conclusion, while the U.S. benefits from the unique status of the dollar, it cannot overlook the basic economic rules that apply to all countries. Continued reckless spending will eventually lead to negative outcomes. The government needs to take active steps to deal with the national debt, whether by cutting spending, reforming taxes, or a mix of both. Failing to do so could result in a financial crisis with wide-ranging effects.